Wouter van Driel, all the way from Amsterdam. How you doing, my man?
Doing great, Matt. How about you, man?
I'm doing good. I'm doing good. Listen, I'm very excited to have you here. I was waiting for this for a while, to start the show and invite some of our great colleagues, friends. Wouter, we've been knowing each other for like a couple of years.
True.
You know what I think about you and about your execution ability. So I want you to bring in here to the show and one, inspire with your own origin story that I think is fascinating. And two, the business that you've built. I saw how
Yeah.
you created the business from scratch. You
Yeah.
came after your exit, and then we got together through Willem, our CMO.
Yeah.
So it was amazing to see you for the past few years grow and now coming up with amazing projects and amazing mandates. So we're going to get to that in a second. But let's tell the audience that you are based in Amsterdam. How things
Yes.
are going in Amsterdam? You have the wonderful view outside. How things
Yeah.
are going in Amsterdam? I know that my fellow Americans, they love Amsterdam to be there for a week or two. Some of them
Yeah.
said 10 years ago that Amsterdam was the best place to travel outside of the United States.
And
I
it still
guess
is.
it still is. Here we go.
Yeah.
We have a patriot. So how things are going in Amsterdam for you in the
Doing
past few
great.
years?
Yeah, so first off, thanks for having me, Matt. I really appreciate it. It's like you said, we go way back, so I'm just really excited to be a part of this. In terms of Amsterdam, everything is great. Obviously, the weather in the Netherlands is notorious, so it can snow at 11 o'clock in the morning, at 12 o'clock there's sun, then there can be rain, and then sun again, cloudy. It's a whole wide mix of what we have here, but I think that's also what makes the city beautiful. So I think I'm very privileged to cycle to work, so that's I think the number one sport. We've got actually more bikes than people here in
Wow.
Amsterdam. So that's, yeah, I'm very privileged and very happy. In terms of business, we're here with the entire team. It's busy, it's hectic, long days, long nights, but I wouldn't have had it any other way. So yeah, it's going really well.
And for the ladies who look for tall guys to marry, I think the Netherlands is the best place out there, right? Let's be honest.
Yeah, without a doubt, without a doubt.
A lot
I
of
do
a lot
think
of a lot of tall
you gotta
people.
work with the directness, but for the rest, no, people are good here.
That's awesome. Let's get this disclaimer out of the way and move on to our interview. It's going to be very valuable. So before we start, a quick disclaimer: this interview is for informational and education purposes only. It is not an offer to buy or sell any investments or security. This is not an investment advice. For more details, please check our website or the description below this video. Walter, I have a question for you, right? We know each other for a few
Yes.
years. I saw how you started your firm, right? Van
Yeah.
Driel Capital, that's your last name. And it's been incredible watching you, as I mentioned, build it. But let's
Yeah.
go back to the beginning, right? You were heavily involved in the e-com space,
True.
launching your own company when you were 22, over a decade ago, scaling that into millions in the Australian markets. You were in the
Yeah.
Netherlands, working on the Australian market. What made you think when you were 22 that you could do it? And you can explain a little bit about that story.
Yeah, no, definitely. More than happy to dive into that. So I have to dig deep into my memory because it's such a long time ago. But basically, I was in the crossroads. So it was either, right, I'm going to go work corporate, or I'm going to do something for myself. And I think I got a nudge from a good friend of mine that said, hey, listen, I think you'll be very much suitable to start your own company. And of course, I was young. I was a bit reckless. I was like, yeah, I'm just going to start, see how it goes. Worst case scenario, I'll go corporate and I'll go on payroll and that will work out as well. So I think I was a bit deluded, but I think that's what you need if you're an entrepreneur. You need to have some guts, even though you're scared, you don't know what's going to happen. So that was really for me the starting point to start my own brand. Obviously, I experimented back in the day, like with multiple companies. I did different industries, but at one point it stuck. And yeah, from there it grew quite fast. And at those times, you're not really equipped sometimes to manage with the stress and the responsibilities that come with it. But that's basically in a short summary how I started, Matt.
It's fascinating because again, in the US, being an entrepreneur is common. We know
Sure.
the American dream, a lot of immigrants. I immigrated to the
Yep.
United States. So we all understand that. But for the average, and I would consider you the average smart individual, like that is European, for you guys, it's like going to college, getting a great job, and
Yep.
just doing
Very
that. You
true.
don't really think about that. And I met a lot of people from Europe. This is why I was
Yep.
pretty impressed and surprised by your mindset. I'm not saying that it's not popular at all, but for you as a
No,
22
you're
years
right.
old, tell me a little bit about that culture and how did you come up with the idea? Were you terrified? Did you have any support from your fellow friends, family, because it's not that popular, especially in the Netherlands. It's a small country
Yep.
eventually, right?
That's very true. So yeah, of course, I was scared, and getting to that decision in terms of like the Dutch culture or the European culture, I think you're completely right. Like when we think about entrepreneurship, we look at the US. I think a lot of people and a lot of businesses look at the US for innovation, for entrepreneurship, and the majority of my friends, I would say around 90%, obviously, besides the friends that I've made from entrepreneurship, the vast majority is in payroll, has a couple of kids, a house, a car, goes to work every day. That's completely fine. But I also wanted something more. Like I felt like, all right, I want to discover the world. I want to travel. I want to do something for myself. And I was like, yeah, this is something that I want, and I'm just going to give it a go. And obviously, you just sort of roll into it. It wasn't like I sat down at night and saying, I'm going to do this, but you roll into it and then it evolves. And in terms of support, I'm very fortunate enough to have great people around me, friends, family, my girlfriends. They've always been very supportive, but obviously in the beginning, when you're young, your parents do sit you down and say, listen, we do think you need to start working. I don't think this is quite high risk. I've had some couple of tough discussions with my parents about that. But I think in hindsight, I was stubborn enough to do what I wanted. And I'm really glad I stuck with that.
No, that's incredible because this is my personal opinion. I think it comes naturally to you.
Yeah.
It comes naturally. You are an entrepreneur. That's your DNA. That's how I feel about it. When I did my research on entrepreneurs, even if you start at X career,
Yeah.
eventually you're going to lean towards being an entrepreneur as you explore. Sometimes,
True.
you're not that lucky enough to be born at a situation when you have the ability, but eventually, if you do enough research, you can come out of any situation. And we saw so many stories.
Yeah.
I'm just curious, behind the scenes, we always speak about taxes and regulations and things that are a little bit different in
Sure.
Europe and the Middle East or the United States.
Yeah.
But we all understand that it's possible. Now, coming back to the end of that chapter for you, before
Yeah.
you got into entrepreneurship, you did an exit.
I did.
Why? What was the thinking behind making an exit? And that's kind of it's so fascinating because it got you into the sell side mandates afterwards and helping other people to make an exit naturally. But what was the thinking process before you made an exit? Just can you give more color to the audience? What was the business and what was the kind of the thinking phase?
Yeah, no, definitely. So at that stage, I ran the brand for a couple of years. And I think a lot of entrepreneurs will recognize this, but you basically come to a crossroads. The pressure increases, the team increases, complexity increases. Obviously, you have challenges with your cash flow, and it's a constant battle to improve. And especially in the consumer goods space, it can be very changeable. So I came to a point in which I was saying, okay, is this something that I would like to do for the next 3 to 5 years? Is something I want to make the investment both financially and mentally to grow this brand? Or do I want a fresh step and want to do something completely different? And I think especially in the consumer goods space, in the market I was in, it wasn't talked about as much about exits. It was more like you just keep scaling, see how far you get, and then you make the balance. But luckily, through some research, I found the alternative route. And the brand itself, like you said, we were mainly active in Australia because my girlfriend is Australian. So I lived in Perth at that time. And it worked really well. And I think especially the Australian market, for anyone listening, I think it's a great market. People have a lot of capital. They like to invest into consumer goods. So great market. But that's how it came to be. And yeah, with my fashion brand, it was time for me. I made the balance for myself and said, it's time to say goodbye. So that's how it's basically how that thought process and how it came about.
And what was the process of actually selling? Were you selling 100% of the business? Was it like a typical, control investment and then you shifted out of it? How was the process?
Yeah, it was pretty straightforward. It was a 100% exit. So basically, yeah, all the assets were set over to the investor in London. And yeah, after a couple of months of after sales support and getting the new owner set up, it was time for me to say goodbye. And yeah, after that, I had a short sabbatical. It was not that long because I felt the itch pretty quickly again as well. But that's how it came about. So quite straightforward, I'd say.
You wish you had all of your clients right now as a sales side advisor to
Yeah.
have those transactions, huh? You wish.
I wish. Unfortunately, not the reality, but it's
Right?
part
It's
of the
not
work.
that common. Let's talk
No.
about e-commerce because e-commerce
Yeah.
is fascinating. E-commerce was, especially during COVID, booming, right? Everybody
Yeah.
was
True.
consuming. We got into Amazon FBA back in the day, right? Amazon became huge. Shopify.
Yeah.
Everybody
True.
and their mother had a shop on Shopify back in the day. Now it seems like the appetite. First of all, the market is being very selective. Period. Two, they see the risk because of social media and because it's heavy on ads, right? So they see
Yeah.
the e-com in general. Um, First of all, what makes e-commerce so unique when it comes to an industry versus other ones? Because every time that I speak with investors, they speak with me about all those industries they look for. And then they say, but consumer brands, I don't know, like it has to have something to it. So what is that something? What makes e-commerce so
Yeah.
risky on one hand, so lucrative on the other hand? Is it that cash flow? What it is?
Yeah, so I think first and foremost, what also the feedback you get from your investors is what I sometimes see is that they understand consumer goods, but not truly. So they do see all the risk, they see what's gone wrong. So for example, with the Amazon roll-ups, that basically I think all of them went bankrupt. And the problem wasn't necessarily those businesses, I'd say, but it was a lack of solid integration strategy. That's what I saw going wrong. So that's what I do find unique in consumer goods, and that's what we basically almost solely are active in, is because I understand that industry and what makes a brand tick. So I think I would also display it as two different types of founders. You got the ones, let's say, that focus heavily on IP. This could be, for example, a company that is an indirect competitor of L'Oreal, like the hair care brand. They've got a great IP and then they get acquired solely for that IP, like that type of acquisition strategy. But I think what really makes these brands stick is in terms of operational costs, it's incredibly low. Obviously, a lot of the expense goes to paid advertising, but that's also something that a lot of added value or a lot of value can be found is if you see, okay, these brands have a solid moat, they've got a lot of brand equity, return on customer rates, reviews are high, that reduces the risk. And I understand from an investor's perspective, like you always want as low risk as possible, but the entire world can change overnight. And that's not exclusive for consumer brands. So I see when I look at a brand, I look at, for example, what type of team is behind it in terms of the founder. The location is very important. So that's, I think we'll dive into that a bit later. But the US market is incredibly attractive. You look at the brand itself, the products, the feedback. And if you do a solid analysis, you can see which brands are actually worthwhile for an acquisitions and which ones aren't.
No, that's I totally agree. And I feel it's all about the brand. And when we say brand, we say customers, repeating customers, what people think about your brand. Is it a brand or just you being great at marketing, direct marketing, and getting a lot of sales up front, and then tomorrow Meta, right, is going to block your ad account and you're done.
And you're done. Yeah,
Right? So,
exactly.
because it really depends on what type of investor are you looking for. Some investors are looking to do some sort of a roll-up and they need your brand strategically. They need to acquire you and acquire all of your client base, right? And get them to be a part of like a bigger brand. And sometimes you want to acquire cash flow for X amount of years. So you are underwriting it for 3 to 4 years, value add. I'm going to add more inventory. I'm just going to understand your bottlenecks. And the third thing is the risk is being reflected with the lower multiplier that we see with e-commerce versus like the typical SaaS. So it's not going to be an 8 or 9.
No,
so you have to calculate that as well, right? You see 4x, you see 5x, sometimes you even see 3 or even less. It depends on the situation of the brand, right?
Yeah,
and
very true.
When you want to exit as a founder, you want to exit, period, right? So you had the same situation. So that's pretty fascinating. Now, we did our research, Wouter. We went over your stats and your website, and you made a fascinating claim. So you said that fewer than 60% of attempted e-com exits successfully close. Fewer than 60%. Correct. That's brutal, right?
It is.
What is the failure rate? Why is the failure rate so high in this space compared to a traditional M&A that you are doing as well? And you see the difference.
Yeah, I can shed some light into that. So I think what I typically see go wrong is I think this goes for every industry, is founders are way too late with their exit vision. So they haven't prepared anything. They don't really have an exit in mind. And what happens then is that these type of founders say, I'm completely done with the business now, or the business may have shown some stagnation over the years. Now is the time I want to do an exit. Because typically you don't want to exit when everything is great. You see upwards momentum, the sky is the limit. So why would you think or consider it at all? But that's what I see go wrong, is that, okay, these brands are all the way down and now, okay, they want to do an exit, but typically that's too late. Because even though we always look at the last couple of years in terms of financial statements, it's also an emotional game for investors. Like if the last half year is down, especially in such a fast-paced environment as consumer goods or e-commerce in this sense, it gets very difficult. So that's one thing I see going wrong. Secondly, I see with consumer goods, it's sometimes an industry on its own. So let's say you talk about brick and mortar, it's a bit more corporate or pharmaceuticals. On the other hand, you got sometimes a newer generation of founders. Like I know founders that are 20 years old and that are doing 100 million in revenue, but they don't know what it takes to take a fast-paced company to a corporate environment for an exit. So they don't have anything prepared. So there's no data rooms, no correct financial statements, forecasting, retention agreements, management team, everything is not there. And then, yeah, you come into a corporate environment for that exit and you get the bill, which is sometimes, yeah, thank you very much for showing this opportunity, but we're not interested, or they've just solely focused on growth for in the sake of customer satisfaction. Yeah, well, if you've got a Trustpilot review rating with only negative reviews, I wish you the very best of luck. So summarize, I would say the lack of exit vision when the chips are down, and secondly, they don't know what it takes to actually sell a company, because it's different than a quick flip. But if you do companies with multiple millions in EBITDA, something else is expected.
You like to emphasize those two terms,
Yeah.
founder dependency and transferable value. Can you elaborate on that? Because I feel like, especially in the e-com space, when you have younger entrepreneurs that are incredible entrepreneurs, made
Of course.
millions of dollars, but they don't really get that difference because one
Yeah.
is sellable and the other one is an issue for the investor.
Yeah. So I can give loads of examples. I'll try to condense for the sake of the time. But what you see is they only think about, okay, what is the company going to do next month or the next 6 months? But they don't think about where does the company need to be in 5 years? Like, what do I need? And then basically calculate back to where they're at, reverse engineer to where they're at right now. So they sometimes have difficulty investing into the company. And this can come in multiple shapes or forms. It could be with rebranding, hire senior team members that earn maybe more than they would ever have dreamed of. Those types of things, they're only focusing on the short term, but not the long term. And that's understandable, because there's also no one that has told them how it sometimes works. And I'm not saying our way is always the best way, of course not. If they want to keep it as like a cash machine, sure, feel free to do so. But that's what I see go wrong. And also, they haven't thought about their company from an investor's lens. Because from an investor, it's basically ROI and risk. And I've seen situations in which there was a company and they had one manufacturer, no backups, no testing. A buyer is going to discount that because it's incredible operational supply chain risk. And they don't think about it until it's sometimes too late, or when the questions start coming and then you're scrambling to fix such a thing. So that's what I see is like, they don't understand the impact of the decisions they're taking today could impact the exit or even the continuity for the company if they don't want to exit at all, because there's no one that has taught them that, because they're mostly self-learned and they just came through, I don't know, some friends or whatever it is.
And usually that is the first successful, real successful business. So they didn't sell any of their last businesses. Some of them failed 5 or 6 other businesses. Some of them, had that incredible ability to build their first or second business into incredible numbers. But now they face the issue of getting inside of the investment or the investment bank or the investment firm shoes. And so you educate them a lot, you feel like, or you just pass that and just, have conversations with people that are more educated?
No, I think it goes, we do both. So sometimes we work with founders who have worked in this industry for 10, 20 years. They understand how it works. I think our work in terms of the preparation of the materials when we go to market is a lot less. It's just the refining what is there. But on the other hand, sometimes we do have to do a lot of coaching. And I think that's also something that we're more than happy to do. Because I know with these type of founders, they're not going to exit once. They're going to exit 2, 3, maybe 4, 5 times. And if we can give them the tools to do these exits successfully, they'll come back and they'll do a lot more exits. So I think it's also, in our community, or being an entrepreneur, being an M&A advisor, it's important to have coachable clients. Like if they're not coachable, then it's going to be very difficult and we're probably not going to work with those people. But if they're willing to learn, like no one is perfect. Like I know people in their 60s, 70s, and they're still learning every day, maybe from the new generation. So it goes both ways.
No, and that's a huge advantage that you have with your firm, because the larger investment banks, sell side mandates, they're not here to educate you. Listen, they go over your P&Ls, you're either ready or not, and they're going to pass on a deal pretty quickly. One, they need a specific number to hit when it comes to your exit and get a percentage out of that. They need a specific retainer. And if you're not, if you're not ready, just go to an advisor. So you have enough room. So you kind of fill that gap with people that like, they can be experienced and they can be great, but they need that extra, you can say extra eyeballs, right? To just go over the things from an investment perspective, right? From an investor perspective. Let's talk a little bit about, again, your ability to close, right? Your close rate is over 80%. That's significantly better than the industry average in your space. What are you doing in the preparation phase that most advisors skip or get wrong, in your opinion, working with other advisors as well, obviously?
Yeah. So what we try to do in terms of that percentage of the high success rate that we have is we try to prepare these companies way before an exit. The earlier, the better. So typically we work around 1 year before the company goes to market, so before they exit. And we try to do it very extensively. So we go basically through every part of the company. It's organizations, legal and IP, fiscal, financial, supply chain, contracts with team members, retention agreements, basically everything that entails the entire company, because then we got a complete picture. And obviously we'll never know the company as well as the founder, but we got a lot of time to fix all the gaps that are there. Because for us, when we bring it to market, it has to be a no-brainer for the investors. And yeah, that just gives us a lot of time. It also gives the founder peace of mind that knowing when we're ready to exit, we can actually do it. And the rate is just a lot higher. So I'd say that's the big part why the success rate is over 80%. Secondly, we're also a bit more selective because we know a lot of investment firms or M&A advisors that maybe do 100 deals a year.
Mm-hmm.
And if they close 30% of that, for them, that's great business. They've closed 30% of the companies. For us, I like to work also with brands that I get excited about because my team has to work with them. And I find it sometimes difficult to represent a company that I don't believe in. So we try to, in terms of volume, be a bit more selective. But then on the brands that we do work with, we commit every resource that we have to get the deal done.
And again, that's incredible because I always say preparation meets opportunity.
Always, yeah, you actually always say that.
And that's what you provide, right? That's what you
Yeah.
provide. Even if they're not ready, you can provide them a solution. Let's get you ready. Because
Yeah.
you are going to do it either way. Worst case scenario, you don't do anything.
And you got a better
And you
company
gas
for it.
out, right? And you gas out,
Yeah.
and the business goes down. And it is
Yeah.
what it is. Because as soon as you think about exiting, something left the building already.
Yeah, that's true. That's that's true.
And you
Yeah.
saw that with a lot of founders, right? As soon as I think about it, it means that as an entrepreneur, I'm already thinking about my next chapter, and it's all about focus. So
Yeah,
if
and that's
I'm
always a
not
tricky
getting-
situation.
Exactly. So if I'm not getting the next CEO or the next management, something already left the building. Maybe you're going to do
True.
great. Maybe the market, something will change in the market and it will, boom your entire business. But at the same
Yeah.
time, especially with e-commerce, you don't really see 4, 5, 6, 7 years of being successful. You have to get
True.
that right timing. So if you come to Wouter and his team right before that, even if you are 12 months away, that's the time to have that motivation in order to prepare, build, and exit properly for the right multiple, right? For the right
Exactly.
multiple.
Yeah.
So that's fascinating. Now, coming back to Europe, the different, you know us. We like some comparison. Coming back to you based in Amsterdam, you work with brands across Europe. I always encourage you to work with the US, Canada, North America in general. I thought you can be great. Your core is in Europe. Now you're expanding. We just spoke about it right before we started that you secured another mandate in North America here. So you work with both buyers and sellers. Now, can you give me the biggest differences between working with US buyers, US sellers? Kind of two questions, right? US buyers, US sellers in Europe versus, and again, you work in Western Europe, so maybe it's a little bit different than Eastern Europe.
Sure.
People don't really get that. Not all Europeans work. It's not like the US that you have a lot.
Europe is not a country. Exactly. Yeah.
Exactly. So kind of buyers, sellers, how you compare Europe or your clientele to the American clientele.
Yeah. So first off, let's maybe dive into the sellers first, so the founders. What I do see is the founders in the US are more educated, like you said before, in entrepreneurship. Like for them, it's not a crazy thing to raise 10 or 20 or 30 million. That's just part of the game. Dilution is part of the game. And they know how to get there. They've got the contacts, they've got the know-how, usually a bit more senior team. Like that's, I think, the biggest difference that I see compared to European founders. A lot of them are first-time founders. They don't have such an extensive entrepreneurial network, don't know the right people. They don't know, for example, the right fiscal advisors, bookkeepers, partners in agencies or whatever it is. So I would see the Dutch or the European market is just a bit slower and is just not as developed and fast-paced and also accommodating in terms of investment. Like that's what I typically see in terms of the seller difference between Europe and the US. Now, if we're talking about the buyer part, I think that's where I see the biggest difference because I think, yeah, with sellers, I think they all sort of speak the same language, but with the buyers, I see the biggest difference. So I can give like examples is Dutch buyers are incredibly direct compared to maybe in the US market in which they're maybe a bit more politically correct in a way that they'll entertain everything. But the Dutch buyers or Western European buyers are saying yes, no, and that's it. Very, very direct. I like that, but of course. But then you also look at maybe in terms of the deal terms and the risk aversion that Europeans typically have. They're way more risk adverse. They're a bit more traditional. They are very tight on deal structures. But what you do see is that if they are actually interested, they're more likely to close. And I think in the US, because there's so much opportunity there, of course, there are more buyers, but the buyers also have a lot more opportunities. Yeah. So that's what I also see. So if I can just flatten it down and make it very straightforward, I think in the US there's a lot more upside, but sometimes you don't know how serious someone is, even maybe during a letter of intent or in due diligence. But I think the deal terms are usually typically a bit better. The multiples are higher. And in Europe, it's more tough, a bit more slow maybe. But if they are interested, the deal is very likely to get done. That's just basically the difference. And obviously, it's not always the same. But I would say over the deals we've done, typically, yeah.
No, I get that because when you speak about sellers, people are people eventually. People are people. Different cultures, so it changes a lot. But again, it's not like the Asian culture or the Middle Eastern culture that is way different, right, than the US culture. So you see the difference. Yeah. And you always need to adjust, and that's fine. You know, every culture is kind of different. But European culture, I think that, again, I want to hear your thoughts on this. They are much more conservative. And again, always looking at mitigating risk, so less opportunistic at their core, right? At their core, just because of history and education and culture, right? This is culturally
very true.
How they react. And as we mentioned before, if you have less entrepreneurs and it's harder to create a business in Europe, you're most likely to say, hey, if I'm going to sell my business, I don't want to get into specific kind of complicated structures as well. I just don't know, right? So in the US, your neighbor sold this business yesterday, right?
That's what we always say, right? Like the US innovates and sometimes the EU regulates. And that's very typical there. I think especially in Europe, and this maybe besides the M&A talk, but I think people need to support entrepreneurs here way more. And I think in the US, it's just it's the perfect environment to be an entrepreneur. And I see a lot of guys that become incredibly successful. They actually move to the US because there's a lot more opportunity there. So that's what I typically see.
What do you like about Europe, right? We understand that the advantages of the US market, North American market, more entrepreneurial, maybe less taxes. The environment is a little bit more friendly, but you must have some advantages in the European market. You know that. I don't know them because I never lived there, so I don't understand the founders and the buyers. I encourage you all the time to go into the US market, but at the same time, I'm curious to find out what are the big advantages in your market versus the North American market.
Yeah, so I think in terms of when we're specifically talking about consumer goods, what I think Europeans understand really well is the brand equity part. Like Europeans, sometimes they like to be quite classy, like if you're looking at the French, the Italian, but Western Europeans are also, they are very committed and very structured in their ways. Like if they see an opportunity, if it's needed, they'll grab it. If it doesn't make sense, it doesn't. So I think that's what Europeans are typically quite good in, is like weighing the ups and the downs and then making a decision and sticking by it. So that's typically what I like about Europe, because obviously I'm still here, and if I didn't like it, I would have moved. So I think it's also, that's something that's really nice. I think the blend of so many different languages and cultures, I think that does open us up to look more at the world. While you see a lot of brands in the US, they probably will stay in North America. But what you see with the brands over here is they start in Europe and then they get into the US or the UK, and they already got a strong brand moat. So I think that's what they're not afraid to look all the way across the other side of the world and then start there. Could be as simple with just starting a 3PL in the East Coast. But that's what I do see is like Europeans, they are very world oriented, and the US is maybe a world on its own.
Right. How I see that from the outside, from my perspective, looking at you grow, you just see the opportunity. And you want to get the best out of both worlds. So you get a lot of your knowledge from, making deals in the US, and again, getting deals on a regular basis from the US, and you try to get the good things to Europe and educate the founders, educate the buyers, and again, they are shifting towards it. If you want or not, people are shifting towards it because they are under the umbrella of entrepreneurship. So maybe
Yep.
the regulations will be a little bit different, laws and everything, and culturally. But I feel like, as you mentioned, it's just going to be easier to come up with the American entrepreneurial culture to Europe versus the opposite.
Yeah.
So today, if you
True.
want to pitch the average investment firm, like a business that is based in Europe, it's going to be much harder than the opposite. So
Very true.
that's how we see it. Let's talk a little bit about your deal flow and how you operate. You operate through like a private off-market network. We love that as well. When I first spoke with you and you asked me like, how do you do that? I'm like, I'm doing only off markets for a reason. I'm curious to
Yeah.
hear about your reason. Why off market? Because you had the opportunity to do traditional, right? Kind of bid war, getting online, getting bids, whatever. You do it
Yeah.
privately, you don't do it online. So why is that? What's wrong about traditional like kind of auction process listing on the marketplace versus what you do?
Yeah, so I think the reason why we're doing this is because we deal with a specific type of brand or businesses. And sometimes what you see is, let's say you get put up a marketplace, and the marketplace can be a great tool to gather extra attention and a lot of momentum. And that can work really great. But I would say is the way we evaluate it is that our clients sometimes they say, "Hey, Wouter, I got a great offer, but I'm not taking it because it gave me the confidence to keep growing and scaling," and that's a valid strategy. On the other hand, sometimes also a business does not sell for whatever reason. It could be that the last couple of months were very tough, and if your brand has basically been everywhere listed, I think in a way it can become a bit infected because buyers will think, why hasn't this sold yet? And something must be wrong. Otherwise, someone have already acquired it. So I try to be cautious also with the reputation of the founder and of the brand. And I think also in terms of off-market deals, because you're sometimes dealing with people that you've known for years, have done multiple deals with. So for example, we know a buyer in the US that actually did a cross-border transaction in the Netherlands. We know how they work, we know what they want, and it's a lot easier to work with those type of people. And I think in closing, I think I also try to protect my clients from tire kickers, which you have, I think, quite a lot if you do like a bidding war or something like that.
From a buyer perspective, obviously, I would love to do an off-market deal, right? Talk with you privately, right?
Yeah,
And you know, negotiate privately and get a deal done, maybe for like a specific amount that I wouldn't be able to get during an auction. But let's talk about the seller perspective. Do you think that a lot of them just want to keep it low key, don't want to get all the noise? And
yeah.
hey, buyers will know that. But if I'm a consumer and I see that, it could affect my brand potentially, or no? How do you see that from the seller perspective? They're
Yeah,
afraid
so
of
from a seller, no, I think the seller perspective, because we're talking a lot with founder-led brands, is a lot of them want to stay anonymous, mostly. So that's also why we usually don't really disclose the brand names, is because I want to stay anonymous, and that's fair. Secondly, I do think you still can create competitive tension if it's off market. You just have to know, you have to build out a big buyer network over the years. It takes time, it takes effort, but you can still build competitive tension. And I think, yeah, like I said before, most importantly, you can still create competitive tension, and B, you want to protect the reputation of both the brand and the founder. So that's why we choose to do that.
Speaking about founders, speaking about strategies that they can leverage, one of them is obvious, exit the brand. But what if
Yeah,
they are not ready? What if, one, I'm not ready, or two, I want a partner. I want a partner to help me scale. I just feel like I tapped out when it comes to my resources, energy-wise. I don't know how to build it with more than 10 employees, 15 employees. I don't have the capital. I don't have the connections. If we're talking about e-commerce, maybe I want to get into the B2B space, right? The
yeah,
retail space. I don't have the connections. So you have a service called Exit Raise, right? So it's not a full
yes.
exit, it's Exit Raise for founders who are not ready for any reason to exit, but need capital or connections, right, to scale, or strategic capital to scale. How do you know when a founder should take growth capital versus just to sell now? Because I bet some of them are kind of coming for the opposite. They say, hey, I want growth capital. You look at their business and you're like, hey, my recommendation just to sell it and move on, right? Growing
Yeah.
it for you is going to be a little bit more challenging. So how do you look at this?
Yeah, so I think first you need to have a conversation with the founder. That's most important because it's difficult to get them to nudge them into a certain way that you think makes most sense if they're completely opposite of that or they think completely different. So you have to understand the founder's ideas and motivations. That's most important. But when I look at whether you're going to do a full exit or a raise, it also comes down to their own exit vision. Like if they're having fun, if they have a lot of energy, but the only thing they need is a strategic partner to grow, and it could be maybe for R&D, it could be for the supplies, it could be inventory, it could be anything. But if they just need that right type of partner and then they're happy to stay for another 3 to 5 years, I would always advise get a partner and do a raise. But if on the other hand they say, hey, listen, Wouter, I want to do a raise because I'm completely tapped out, I don't have any energy for this, but I just want a bigger exit. Well, then I'll be the first to say it might be time to be thinking about an exit, because if you've got another partner coming in, you cannot check out. Like additional responsibilities, you got to work together with someone. I would advise you to at least start preparing for an exit and then see what comes to the table. Because in the end, whether you're doing a raise or a full exit, you still need to prepare. Like you cannot find a strategic partner and the back end of your company is a complete mess. So I went maybe a bit on the side over there, but to answer your question, what does the founder want? And also what are their actions right now? And listen to that and then obviously advise them in their very best interest.
The potential of the business is right there as well. Some businesses are a perfect fit for a strategic partner, right? So I feel like, Wouter, you, with your experience, you have the ability to either entertain both ways, right? So for example, I'm going to prepare your business. You're prepared to sell at least the majority, right? At least 70% of your business, or maybe 100. So you can create a pipeline of 5 or 6 buyers that could go and buy you out completely. And 5 or 6 strategic buyers that have the ability to buy you out, or their strategy is to invest in you. But as you mentioned, it's all about the founder. Maybe the founder doesn't want to stay anymore, right? Or maybe the founder is like, I'm so obsessed about this business. This is my job. I want to do it for the next at least 3 to 5 years. That's where obviously you can entertain an exit, a full exit. But I feel like in terms of ethically, plus for your clients as well, as you know, as investment buyer, it will be even better, right? To provide them with growth equity, right? And sometimes they're even not ready when it comes to the stage. So it's not even sellable yet, right? Multiplier wise, you're like, listen, you're not going to get 5x or 4x right now, but you can get 4x if you sell a portion of your business to a strategic player and you do some sort of like a projection kind of model where if you hit that specific amount, you can get better multiplier, whatever, earn-out period. You can be so creative with it. That's where I feel like they're not educated enough about this matter, and your program can really, really get them there. So that's really interesting. I bet you had a lot of interesting conversations with some founders. Sometimes there is a difference between, you look at their P&Ls, you look at their business, you're like, wow, they are incredible. But then you speak with the person and you're like, how did they do that if they're not really educated about nothing? Like, you see that a lot or no?
Yeah, I do. Like I said, like that story about the founder that's like 20 years old, doing 100 million. I'm always very impressed with the way they've started something from scratch. And just grow into that role. So I'd say all the conversations I have are always different. You learn new things from every brand, every founder that you talk to. But overall, I always respect the commitment. And you hear fascinating stories from people that make it, that actually do become very wealthy with all the growth or exits they've done. Sometimes you also hear stories of people who got like a 20 million offer. 2 years, 3 years later, it's worth 1. And those sometimes also are the stories. Not fun stories at times, but I think if you're an entrepreneur, you're in it typically for life. You're gonna stay, make new companies, start new companies, and that's just part of it.
We love talking about the market right now because it's fascinating with interest rates and everything. Talking about 2026, as we are expecting to have a great year and great 2 or 3 years, right? The market, the correction of the market and everything. So as we all know, interest rates went up. Obviously, it affected everybody, but let's talk specifically about the consumer brand industry, e-commerce. Consumer spending has been pretty weird. What are you seeing right now when it comes to, e-com, M&A, deal flow? Do you see more? Do you see less? How do you compare that to the last 4 years? I think that when we started speaking, we had maybe interest rates were at the peak, right? If I'm not mistaken. But is it moving, or do you see kind of the same thing?
I see it's getting better every year, but not drastically. So I don't see like a night and day change compared to 2025 or 2024. What I do see, and that's recurring, is the way buyers are intentional with their acquisitions. So they are very intentional with the type of companies they acquire. They always look very deeply whether it's a fit. And maybe if you look at if you talk about the Amazon FBA boom back then, it didn't matter. Lending was basically free. So we'll just acquire everything we can. I don't think that's not the reality anymore. So they look at also the brand mode. So they look at the brand equity, like how strong is the brand? Because a lot of new competitors enter the market every single day. It's gotten incredibly easy through AI as well. So there does need to be a solid foundation for the companies to be an interesting prospect to acquire. So overall, I see the market 2026 improving. I see a lot of deals getting done, and I do see a bit more of a win-win scenario. Like I see buyers actually performing well after they've acquired post-integration. I see sellers walking away with good terms. In terms of deal structure, obviously earnout is still a component that comes back almost every time. But I think it's also a responsibility of the seller to have such a good company. They're willing to bet or put some skin in the game for the acquisition. But that's typically what I see happening over the course of this year.
What happened to Amazon FBA, Wouter? Tell us. Because back in the day, 2021, 2022, it was the hottest. Everybody was looking at Amazon FBA. I just look at the multipliers and I see 5x, 6x, 7x. Is that less inventory in general? Because back in the day, everybody was buying everything and we don't have a lot of those anymore, the mom and pops? Or is that something else? Like, what happened?
I think Amazon FBA was the perfect storm. Everything came together at once. Like you had obviously the people being at home and spending a lot of money. The rates were incredibly low. Like everything came together, which caused the boom in a positive way, and then obviously in a negative way. Because I think the roll-ups that happened, the companies that acquires the FBAs, like I said before, they struggled. They didn't know how to integrate. They didn't know what happened, and afterwards it was basically it all imploded. Like I think the majority of those big aggregator players in the market back then, I think they're all out of business. So that was a massive correction. And that's what you also see. The companies that do remain, they're very solid and they are still interesting prospects to be acquired. But that was a very interesting time, and that's also what I saw. It's like, this cannot go on or keep going well for too long because it will implode, and it did.
And when I was speaking with a lot of those Amazon FBA, the mom and pops, I'm like, sell it.
Yeah.
Sell it. Right now.
The structure is not going to remain for the next 5 years.
Exactly, because it's platform oriented. It's Amazon, right? It's not an independent platform. It's like we had eBay back in the day. eBay was booming. Right now, trying to get and be successful at it. Right, it's possible. Everything is possible. You can go.
Of course.
You can go and raise money, in New York, and you're gonna make it. But at the same time, what are the chances? Back in the day, if you just had an Amazon FBA store that was doing more than 200K a year net profit, you will get amazing returns. So it's just unbelievable. What would be your recommendation? Let's say a client comes to you and say, listen, we're gonna speak about maybe sectors. Maybe that's kind of what makes it different. But would you recommend them to wait 12 months just to get better evaluation, or if they're ready, they're ready? What would you recommend usually?
Yeah, so I typically look at the sentiment of the founder, like how's the energy, how's the passion, are they happy to improve and invest into the company with possibly a lower EBITDA over the next couple of years because they're investing. If that's the case, keep scaling. And I think most important is you need to have optionality. So if you're prepared for an exit, you don't have to take it. But I always say the comparison, if you have the golden ticket Willy Wonka offer, if you're not prepared, it's gonna pass you by. But if you are prepared, you can consider. And it doesn't mean you have to. It could also be that you keep on for the next couple of years and invest, but you have to be able to take it. So that's the best advice I could give to any founder is be prepared and run your company like you're gonna sell it, but that doesn't mean you have to. And I think then as a consequence, because you're always prepared, your company is gonna perform better because the structures are way more in sync and it's more optimized. But that's what I would advise, Matt.
Yeah. I feel like some of them, they're not really ready emotionally to exit the entire business.
That's fair. Yeah, sure.
Right? And they can always entertain like a majority investor, right?
Yeah, of course.
So 70% of the business stay, and they're gonna have like an option to sell the entire thing within 2 or 3 years, right? And then they are like living both worlds, getting most of the cash up front or whatever, but staying in the business. And some of those buying groups will have you to be in the business. Like they will be in the business for at least like 6 or 8 months.
Years. Yeah, sometimes longer.
Even a few years, right? So it will depend.
Sure.
So fascinating. Wouter, we have our final segment. You went pretty fast, Walter. We can speak for hours. It's rapid fire and lessons with the Driel, Van Driel, Wouter van Driel from Amsterdam. So I have three quick questions for you, and
Sure.
then we're gonna wrap it up. So, my first question: biggest mistake you see founders make when preparing for an exit?
Not prepared, not knowing what it takes to actually exit, and waiting too long.
Love it. One thing buyers hate that founders don't realize kills their valuation.
Unrealistic valuation expectations. I think that's one of the biggest ones. And secondly, not looking at the company through a buyer or investor's lens. That's a lot of irritation stems from that.
Amazing. Final question. If you could only give one piece of advice to a founder who is thinking about an exit 2 years from now, what would it be?
Create your own exit vision. So if you want to exit in the future, think about what amount would make it life-changing for you. Where does the company have to be to get to that specific valuation, and what is your post-exit plans? Because what I sometimes also see going wrong is when they start to exit, they're struggling in the post-exit life because they're financially independent. They don't need to do anything, and you don't want to get into that situation. So even if you're 2-3 years down the line, think about the life after and adjust, because this changes basically for me sometimes as well every month with what I want in the future. That's what I would, in terms of advice, what I would give.
And don't you think that advice, if you are not looking to sell, that advice is so critical for your own business, hiring, scaling.
Yeah.
Even if you decide not to scale, you prepared everything as an owner that wants to sell, and you look at your business as an investor versus as an operator, and that's
Exactly.
already better, right? You're gonna improve
Yeah.
your bottom lines, P&Ls, everything will be documented. It's just easier, right?
Very true.
So, worst case scenario, but that's kind of best case scenario. You're just going to scale your business, right? And be a little bit more
Exactly.
serious about
Yeah.
it. Walter, it was unbelievable. Thank you so much for coming. For people who want to
Thank you for
work
having
with
me.
you, approach you, what would be the best way? Is it LinkedIn, email, your website?
Easiest way to get in touch with us is to go to our website, and there's a button at the bottom of the page with Inquire Now. If they have a question, if they want to have a chat, whatever it is, I'm available, and they can send a message and we'll get back to them.
Awesome. So if you are watching that on YouTube, I will put in the description Wouter's company website. Plus, if you do that on LinkedIn, I will tag Wouter. You can go into his profile, send him a connection request, go over his track record and obviously his company, and approach the team. I'm telling you, Wouter is one of the most professional individuals that I know. He can take you through the entire thing, and he's honest. If you're not ready, he's just going to tell you, hey, come back in 6 months, come back in 8 months, it's fine. There is no rush. And that's a big advantage with working with Europeans. Sometimes, no rush, right? No rush to sell. It's all good. Come back in 6 months.
Very true.
We're gonna get to a coffee shop in Amsterdam and sit down and walk through your business. So awesome. And that's a part of the deal, right? Walter, if I'm
Of
coming,
course.
having a deal with you, selling your business through you, you're going to invite me to Amsterdam and sit down.
Yeah, always. That's I think one of the best parts of my job. When we do an exit, we take our client out for dinner, and we just celebrate, which I think is incredibly important.
That's
I love that part.
Incredible USP. Amazing, Walter. Thank you. So for the people who are watching us on YouTube, please subscribe, comment below. Let us know if you have any questions for Walter. If you are watching us on LinkedIn, be sure to follow our page. We always post new quick short videos over there, and you can watch the full podcast. We have that in the comments. Up until the next time, Walter, thank you so much for coming.
Thanks for having me, Matt. Take care.